offsetting trades. To close out your long spread, you'll need to buy the short 45 put for the current price of $5.25 and sell the long 50 put for the current price of $9 for a net credit of $375. $9 minus $5.25 equals $3.75. The total cash you'll receive from the spread sale is the $3.75 credit times 100 shares, or $375. Since you originally paid $200, your profit will be the difference of $175. As any bear put spread is moderately bearish in nature, a decrease in the underlying stock price should be expected for profits to occur. At expiration, if both options are in the money, trading at their intrinsic values, and the spread can be sold for its maximum value, you'll realize the maximum profit. Again, this situation should occur if the underlying stock closes at any point below the lower or short strike price. This maximum profit is theoretical because it assumes that the spread can in fact be sold for its maximum value. In reality, you may only be able to sell the spread for somewhat less. Why? Why would you or anyone else want to buy a spread for its maximum value if it had no potential for its remaining lifetime? We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.optiontradersnetwork.com. Thanks so much.